Hello, Oxford Retirement family. This is Chris Thomas, and today I want to go over why not to panic in volatile markets. Big question we're getting from clients this year is, what do we do in volatile markets? What's the game plan? Should we run to cash? Should we switch investments? What should we do from here? The biggest thing we could say is that the best days do come after the worst days. We've seen it historically. We've seen it in 2020 after COVID when the market was down 33% in a month. We saw it last year in April towards Liberation Day when market was down 18% from its high. Well, both years the market ended up positive. And for those that stayed invested, they actually saw a fantastic rate of return. Historically, that's typically how it is working. I'm going to attach a spreadsheet at the end of this that goes over what it looks like getting out of the market and missing the best days because the results are staggering. It's a big difference between those that stayed invested versus those that just missed a measly 5 to 10 days of market performance. What to do for those of you with money in cash? For those of you with money in cash, the biggest recommendation we could make is dollar cost average in. We're not throwing everything in at once and hoping for the best performance, hoping we got it at the lowest point. We're going to try and not time the market, but get it in incrementally, just like you did in your employer plan, your 401ks, your 403bs, TSPs, 457s. What you were contributing to out of your paycheck every 2 weeks and buying into the market is the reason why you've seen such great performance over the last 15, 20, 30 years while you were investing at work. And that's the same thing when you're retired. For those of you that have savings built up in cash, it's saying, okay, we're starting to see volatility. We normally say, wait for a correction. Correction is any 10% sell-off from market highs. Wait for a correction and throw 15 to 20% of your cash into the market for higher growth. At least that's the hope. Well, we don't know if 10% is the lowest. I don't know if it's 20 or 30%. That's why you do smaller chunks and you do it over time. Buy in monthly, just like you did with your employer plan. Big recommendation for those of you that are in cash. For those of you that are invested, again, best days come after the worst days. We're looking at, well, if market's down 18% like it was in 2025 through the first 4 months of the year, it's not running to cash. It's staying invested the course of the year. And we could see a repeat of what we just saw in 2025. We saw it go from down 18% to over the course of the year up over 16%. Long-term investing, not reacting out of emotion or fear. I know it's scary, but as we are doing that, stay invested, keep the long-term mindset, trust your advisor, as well as reviewing your portfolio. Do any switches need to be made? Am I too conservative in a down period and now I want to take more risk? Am I too aggressive in a down period and now I want to back off of risk? Everything can be discussed about and mulled over, but come talk with one of your advisors. You can always reach us at 623-933-9508. Thank you, guys.